everybody, Ben Nelson here. Hope you are having a fantastic day. You're listening to this the day after Christmas, so hope you and your loved ones had an amazing Christmas. And you are ready to now head towards the new year and jump into 2023, ready to go and ready to hit your goals. So we're going to jump into it today. I'm excited about 2023 for a lot of reasons. I'm excited for this podcast. I've got a lot of guests that I'm planning on and getting lined up for next year that I'm excited about, and I think you're going to learn a lot from. And so I'm looking forward to that. I have a lot of goals that I am looking forward to hitting in next year: business, personal, everything that I want to make happen next year. So I am excited about that. Hopefully you are making some plans for the next year as well, and looking forward to making some progress in your personal life, in your business, in your health, all those things that you want to be accounting for. So today I want to talk about investment strategies for the new year. What investment strategies should you be looking at in this next year? And I always want to start with, the market dictates a little bit, but a big part of what you always want to do, if you have not done, and if you've listened to this podcast long enough, I talk about this a lot, is that what do you want investing to do for you? And again, credit where credit is due. Always, that comes from my listening to the Real Estate Guys radio and their whole take on your personal investment philosophy. And a lot of people just really don't think about that sort of thing as often, as much as they should. And they just start investing, they start buying property, better than not buying. But you really want to step back sometimes, do it up front if you can, and then do it from time to time and say, hey, what's my investment? What are my investments doing for me? What are my goals? What do I want them to accomplish for me moving forward? Because it changes over time as well, right? Your needs, your availability, your risk tolerance, all of that can change over time. So if you're not looking at it on a regular basis, then you could be continuing to do the same thing that you've always done, and it's really not getting you where now you want to go. So always want to start there. So be looking at what do you want real estate to do for you this next year, this next 5 years, and start there. From there, you have to look at what is the market doing and what is the market that you're invested in doing. And you may have to consider looking at some different markets if what you're wanting to happen is not happening in the market that you are currently involved in. So all things to consider, the high level, make sure you're looking at those things so you are doing things that are going to actually help you reach your goals and that that it's actually possible. And Anita, my colleague, and I, we were just doing this in our goals planning for this next year, doing more in the investment space as brokers, more with apartment owners, things like that. You can put goals down, but you also want to, you got to break down what's possible. You can say all you want, this is what we want to sell, this is how many people we want to work with, but you have to look at, okay, well, what happened last year? How many sold in this category? How many are likely to sell this next year? What percentage of that business that, do we need to get to hit our goals? Is that a reasonable number? All of that, right? So don't just set goals and pull them out of the air. Make sure that you're looking and digging deep into them and make sure that you know what you need to do to make that happen, how many calls you need to make, how many letters you need to send out, whatever you're doing for your marketing, your prospecting, and that it's a realistic goal, and that you can, you're setting yourself up for success and not for failure. So here we go. Let's jump into investment strategies going into the new year. And a lot of this is a function of market, not necessarily your individual strategies. So just keep that in mind. But you may have to think about adjusting a little bit on your strategy moving forward. So here we go. Let's jump into it. So first things first, think long term. It would be really easy, I think, to say, I'm just going to sit out these next couple years and see what happens in the market, see what kind of price adjustments or value adjustments happen over the next year or so. I would say that there's some validity in doing that potentially, right? Depending on what you're looking to do. However, again, timing the market is not realistic. So by the time we're at the bottom, it's already come back up, right? So unless you get really lucky, you're not going to time the market. And the big thing that I want to touch on here that I want to make sure that everybody just remind everybody of is value is important. Absolutely. Value is only a part of the puzzle. It is one piece of the puzzle. And yes, if you are buying and you are turning around and selling, if you're a wholesaler or if you're, fix and flipper and that's what you're doing, value is probably one of the most important pieces, if not the most important piece, right? But if you are a long-term investor, if you are buying properties, if you are acquiring property and with a goal of holding on and buying more doors and keeping them for the long term with all the benefits that has to offer, appreciation over time. Yes, we might be in a market where, and this is on a national level, obviously we could touch on all the markets. There's a bunch of markets around the country that are seeing price declines, but there are still markets that are holding steady, and there are still markets that are increasing. So that's, again, as you're looking at markets, something to consider. You move in and out of markets like you move in and out of sectors in the stock market. Now, I'm not a stock guy, so I can't speak too much to that. But when the tech stocks are doing poorly, you maybe that's so. And actually, so slight caveat or slight sidebar here. When do a lot of stock investors buy, right? When the market is down, right? Because they know it's going to bounce back. So just because the market's down, and even if it continues to go down, it doesn't necessarily mean it's a bad time to buy, because the only reason that it matters if it goes down is if you're a short-term investor and you are looking to sell it in the near future, then it absolutely matters what happens here in the next 6, 12, 18 months. But if you're a long-term investor, it really doesn't matter. Yeah, okay, then equity might be nice, but you're buying for the cash flow. You're buying for long-term appreciation. You're buying for the fact that you're probably leveraging and you're getting amortization on your loan, right? You're getting equity that way, and someone else is paying for it for you. Someone else is paying off your loan. There's tax benefits, all of those things. So don't lose sight of all of the other great benefits of owning real estate by getting so focused on just the value piece and what if the market goes down. Okay, it's something to consider. You want to look at what markets you're buying in, what markets are strong, what markets are likely to rebound best, especially as rates come down and things like that. But don't get so caught up in it that, okay, if prices go down, I can't risk that and I'm not going to buy. Maybe, depending on your scenario, but look at the whole picture. Look at the full picture of all the benefits that you get and know that the value can fluctuate. The value is going to go up and down. Who cares? You have all the other benefits, and in the long term, it's going to go up, and you're going to gain equity in a lot of different ways. The other thing to remember is that there is still a huge pent-up demand for housing. It's been set aside for now because rates have been where they're at, and the economy is a little bit in question and things like that. But it does not take away the fact that we are still millions of housing units short. And add on to that builders have not stopped building, but they're being more hesitant, right? Permits are way down. There's a lot less inventory that's going to be coming on the market over this next year. And look at how long it took us to recover from that shutdown in the 2008 financial crisis. Builders essentially stopped building, and we've been trying to crawl out of that hole since then. And we were actually making some progress, and now we're gonna be moving backwards again. So, there's going to be, when rates settle down, and they again, don't expect 2.5%, 3% interest rates again. 5.5%. When they get back down there and they are holding steady, get ready, because it's going to be another time, probably not like it was before, the craziness, but it'll be a solid market. And you're going to see price growth again, right? Because that pent-up demand is there. It's just kind of sitting in the background waiting to see what happens. People are combining households, things like that. But the demand is there. People want to buy houses. There's not enough housing units. It's just kind of in a hibernation mode right now as we're trying to work out some things in the economy. So again, think long term. Okay, so let's get into the strategies. That is I know I spent a little bit of time on that, but I think that's a key component, so I didn't want to skip over it. That you definitely need to think long term, and in these strategies, a lot of them you have to think long term. So I didn't want to skip over that and not set that context. Okay, this is something we have not talked about in a long time: negative equity. Wow. Okay. So there are a ton of people with equity right now. Equity is still at an all-time high. So why would I talk about negative equity? Because if you bought, as in a lot of markets, not every market, but if you bought in the last 6 to 12 months, you probably have negative equity. And that's a very broad statement, but Portland Metro here, we peaked in May. We're down about 10% since then. I haven't looked at the last market report, but I think that was through I think that was through November. So in 6 months we've gone down 10%. So you're underwater 10% if you bought and you did a low down payment loan, and that 3%. Conventional, 3.5% FHA, 5% conventional, you have negative equity. What happens if you need to sell because you are moving for a job or some other life circumstance, right? A lot of people aren't going to be able to sell or want to sell. They probably don't, maybe they don't have that. If you put 3.5%, 5% down, you probably, not always, sometimes people just want to preserve their cash, but they probably don't have that money to pay off the difference, right? So what do? They have to sell. They can't pay a realtor to sell and take a hit on their equity as well, right? They're going to have to come up with tens of thousands of dollars. How do they do that? They can't. So now we're talking about looking at some creative strategies with negative equity. That's going to be things like potentially short sales. We haven't talked about short sales in a decade or probably more because it just wasn't a thing. And yeah, there were probably people still doing it. Very rare though, like very, very rare. It was a big thing for a long time, right after the financial crisis, but it's been a long time since that tool has been necessary. That is a long process that is drawn out. That is, but there are ways that can work, and you can make it work for you as a buyer and for the seller, so they don't have to come up with that money, especially if they're not able to. Lease options, right? Long-term lease options where you're leasing it from them. You're going to sublease it. You want to set it up where you get you're going to take on that responsibility now. So you're going to get the benefit of that amortization. So there's ways to do that. But a lease option is a great tool right now where someone can, now you're taking on the responsibility of their payment essentially, right? You're paying them rent and then they'll pay the loan. And so they don't have that hanging over their heads anymore. They're moving out of state. They don't want to be long distance landlords. And as an investor, you can let them know, oh, hey, I'm not just a tenant. Yes, you're renting it to me, but I'm an investor. This is what I do. You're not just renting it out to someone and now you got to manage it long term. I'm going to take on that responsibility. I'm going to sublease it to someone, but I'm going to manage the property. You don't have to worry about any of that stuff. So you're taking the management piece away from them, and you're still giving them the income coming in to offset their payment. Or you can do a subject to. So you can buy the property, take title, subject to the existing loan. I am not going to get into all the nuances of that because there are certain things you need to consider. Due on sales clause in the loan, things like that. People do it quite often. I know people that do this and use this strategy a lot. And they never have an issue with it because they set it up the right way and they set the right expectations with the sellers and they do all the right things paperwork wise and everything. So, but yeah, now you're taking on the responsibility of the mortgage. They don't have to worry about it anymore. Yes, they're still on the loan, but it helps them move on. And again, these are situations where they may not have another choice. They may not love it, but no one's going to come in and pay 10% more than the market value. And they don't have that extra 10% to pay it off. So what else are they going to do? And don't you're taking advantage of someone there. You're providing a solution that they need, right? So it may not be ideal for them, but you're still giving them a solution that helps them get where they're going. Okay, so negative equity is going to be a thing. It's going to be something we're going to have to deal with. And as agents, this is something that we need to consider too, because someone may not have the money to come up with to pay at closing, to pay off their loan, to pay our fees as real estate brokers, right? So we got to walk them through some of these options, including potentially a short sale. Okay, I think that's something to pay attention to. I don't think it's going to be a huge piece of the market, but it's absolutely something you want to be paying attention to, and that you could be finding some opportunities in here in the next year or so moving forward. Okay. Next one is value add. This is always something to be looking at. No matter what the market is doing, there are always opportunities to do a value add in real estate. Now, this could be small development. This could be, stabilizing an underperforming asset, apartment building that is just underperforming because it's mismanaged, because the units are out of date. Expenses are really high when they shouldn't be. There's ways to add income with some other amenities, things like that. Lots of things that you can do to add value. Again, it could be small development. It could be partitioning off a lot on something. There's a house on the corner, corner lot. The house is right on the corner. You can slice off the backyard and get an extra lot out of it, and now you've created value. You haven't really taken away value. There really wasn't extra value there in that bigger lot. But there is value in a newly created lot. So there will always be opportunities to do that. And you can pay market value. You can pay current market value for those things for what it is at the time, right? For that single family home on the bigger lot, you're not paying for that extra lot. You're paying the market value for it as is. And then the value you add with the extra lot is extra value on top of it. And this is what I think is great about this market turn is that multifamily owners were wanting, they had so many people vying for their property that you as a buyer of multifamily property, you want to buy, income producing property. It's valued based on the income that's coming in. For the last several years, people were paying for what it could be, or even what it was going to be 2, 3, 4 years down the road, just with rent growth. And so people were bidding up the prices of multifamily real estate, commercial real estate, based on what it's potentially going to be in the future instead of what it was at that time based on the income and the current cap rates. So not only were cap rates compressed and very low, and so prices were really high based on just that, they're also a lot of times paying for future income that's not even there yet. If something's under rent, it's $1,000 a month a unit, but it actually market rent is $1,300 a unit, and in 2 years it's going to be $1,500 a unit. So let's just run the numbers based on $1,500 a unit. We're willing to pay that. We'll wait it out, and we'll get that return down the road. That's fine. We're thinking long term. Hey, that's great. I'm all for thinking long term. You're also speculating a lot. You're also giving away. You're paying for what you're doing. That you're the one that's increasing the rents, taking the risk of turnover. You're the one putting capital improvements in to increase the rents. You're the one waiting it out. So you should get the benefit of that as the buyer. Why are you giving the seller money for and value for what's not there yet? That's not how it's supposed to work. But in a hot market, that is how it works sometimes. You want to get in on the property, you're bidding against 10 or 15 or 20 other people. I mean, what choice do you have? You either want the asset or you don't. So now we're in a different spot where you can go in and you can actually talk to a seller and say, hey, this is where cap rates are today. This is where your income is today. Sure, yeah, it's under rented, but that's not my fault. That's not my problem. Here's the current income. Yeah, I'm going to increase rents, but I'm doing that. So I'm adding that value. That's my entrepreneurship. Instead of giving that benefit to the seller, and then now you're taking the risk of that, but you're really not getting the benefit of it. So there's always opportunities like that, and then there's going to be more now because you don't have to give that entrepreneurship away. You can actually get the benefit of that piece of it. Now, the flip side of this is that people were buying and cap rates continued to decline and get compressed. And so values were increasing just based on that, right? So you didn't even necessarily need to do any of that stuff. You bought, and a year later, the cap rate was 0.5% less, and your value increased by basically doing nothing. With the same income, it was, and there was a lot of that happening. Buy something, hold it for a year, hold it for 2 years, cap rates lower, didn't even increase the income, maybe minimally, but nothing significant, and you go turn around and sell it for 10, 15, 20% more just because of market cap rates compressing. That's gone. That's not happening. Cap rates are going up. Rents are still increasing in a lot of areas, but much, much less than what they were. So, I mean, for the last few years, you had the double benefit of insanely high rent increases. Even in markets with rent caps. Portland has rent, or Oregon, the entire state has rent stabilization. So, but this year with inflation, it's based on inflation. You can still raise it 15% if the market can bear that, right? But yeah, there were markets that went up 20-25% in your rents over the course of a year, and so you had that plus cap rates compressing. You were just making, the market was giving you money. The market was giving you equity. Well, now you got to earn it. Nothing wrong with the market giving it to you, but now you have to find those opportunities. You can't just necessarily buy something and hold it, wait for rents to go up, wait for cap rates to come down. If anything, cap rates are going to go up, and so you're going to be losing equity in that way. So you got to be careful. You have to really know what your value add play is, and that you can offset a rising cap rate environment. So stabilizing on performing properties, there's always abilities to do that. And again, I think there's going to be more opportunities to do that in these coming years because there's not quite so many people, bidding those prices up, bidding down those cap rates. And so there's going to be more opportunity for having those discussions with sellers because people aren't just kicking down their doors to buy their property. The other thing is that I want to make sure that, so opportunity is going to be thinning out. Competition. Sorry, my misspeak there. Competition is going to be thinning out, and that's good. That is good. There was easy money to be made in the market in the last few years, and that's not a good thing. It's not a good thing. It brings bad actors in. It brings lazy investors in and lazy brokers. And I'm obviously not gonna. I wouldn't be able to anyway say names or point fingers, but it's just the way that it is. Anytime people see a way to make an easy buck in a space, they gravitate towards that, right? There's, the easy money, the easy fix, the get rich quick thing, right? And the rising tide, raising all boats thing. It's not good. It's not good for the industry. It's not good for the industry. You want professional investors. You want professional real estate brokers. You want people that take this business seriously, that aren't just in it for the quick buck, and are professionals about it. And again, there's your mom and pop investors, and you may be one of them, and you're not a corporate investor, whatever, that's fine. But you have to be able to take your investing seriously. It's not that I'm just going to buy this and then the market's going to give me an extra 10% and I'm going to resell it. That's not good for the market. It's not good for investing. It gives investors a bad name. It gives real estate brokers a bad name because, then people, hey, you're lazy. You're not doing anything. You're just sitting there making money off of other people, right? So that's a good thing. I actually think that's a good thing. But the market is there. You can make money in any market. So don't think that a market shift is, these opportunities are there. You just have to go find them. Okay, last one, actually two more real quick here. This one is seller financing. I've talked about seller financing a lot. More sellers are going to be quote unquote forced to look at seller financing options because interest rates are high. Maybe they still want the price that they could have got a while ago, but you can't make it work with the interest rates today. So that doesn't pencil, the numbers don't work. You can have that conversation with the seller. Say, look, I can pay you this price, but I can't get a loan at today's interest rates and make it work. So will you seller finance me for 5 years or 7 years or a few years or whatever it is to help get through this place we are in the market so that the numbers make sense now, and then I can refinance you out down the road when interest rates come back down to where it makes more sense. And that's going to make sense to a lot of sellers because they're going to get it. They know you need to make money. They know the numbers need to work for you to buy it. You don't have to hide that fact. They understand it. That's why they bought it in the first place, right? Was so that they can make money. They know you need to make money on it. So you can have that conversation with them. And there's, like I said, there's less people vying for their property. So you actually have that opportunity to have that conversation. Hey, rates are higher, cap rates are going up. Help put me in a position to be successful so that you can be successful as well. Sellers are going to be in a position where they're going to they're going to have to and want to listen to some of those options, which is great because honestly, I know that there were lots and lots of sellers that sold in the last few years that had no idea that there was a better way for them to sell their property. You know, you hold a property for 20 years, 25 years, and you sell it. You know how much money you owe to the government? A lot. So you sell on an installment sale. Well, I don't want to manage it anymore. That's great. You don't have to manage it anymore. Let's continue to give you that income. That's what you want anyway. That's why you bought the building. Let's keep you on that program. Just take out the management piece of it. Now you're still getting the income. You don't have to pay the capital gains. It's an installment sale. And by the way, I'm not a CPA, so make sure in any of these you're advising people to talk to their CPA. But we couldn't have those conversations, and so I know that there were a lot of sellers that sold, took a huge tax hit, and didn't know that there was a better way. So now we can have those conversations and show them that there could be a better way to keep their income going and defer those gains down the road without having to continue to keep that maintenance and management piece of it. Okay, last one here, and this is a discussion Anita and I on our brokerage side have had a lot, which is creating deals. And so what I mean with this is that showing people where it is, they could be doing something different that is better than what they're currently doing. So in our context, in our conversations of this is showing people that own 2 units that, hey, it's great, you've held on to this for 10 years, but you know what, it might make a whole lot of sense to take this equity and scale up and buy 6 units. Why would you keep this equity here instead of, like, it makes more sense to own more real estate, right? Because now you're paying down a loan on more real estate. Once you want to own, you know, instead of a $500,000 duplex, once you want to own a 6 unit that's worth $1.5 million, I mean, you own 3 times as much real estate. So let's have that conversation and figure out a way to get you there and use that equity in a more strategic way. And so what do? Now you take that, and if you're a broker and you work with investors, I'm this is a great strategy, so I'm giving it away a little bit, but that's what this is about: sharing the success, sharing the thoughts, and sharing the ideas, so we can all do better together, right? You show that 2-unit owner that they can buy a 6 unit, and okay, well, I don't have a 6 unit for sale. Well, what do? There's nothing really on the market. Well, you go find a whole bunch of 6-unit owners and you go talk to them and you tell them the same thing. Hey, you've owned this for 10 years. Wouldn't it make sense to leverage this up, to scale up and take that equity and move it into 12 units? Yeah, that makes a whole lot of sense. Okay, well, great. I might have a buyer for your 6 unit. Let's go take a look and see what we can find in some that's 10 or 12 units in a price range that works for you. Let's double your units, double your assets here, and then you do the same thing. And now you've got a seller, you've got a 2-unit that you can transition to a 6 unit, and you've got a 6 unit that you can transition to a 12 unit, and so on and so forth. And you might get to a point where you get, a 20 or 24 or 30 unit owner, and I just want to be done. I don't want to scale up. That's great. This person can buy it. They're selling a 15 unit. They are looking for a 30 unit. Or I'm looking for a 30 unit. Let's talk about seller financing and have that conversation with them. So, and now you just created 2, 3, 4 transactions out of thin air just by having that conversation, showing them how they can do better, and you're helping them all do better. You're not just creating a sale to create a sale. You're actually helping them to do better in their portfolio. So that, which again is the whole point. So that I want to be, if you're a broker, have that be on your radar. Talk to people with smaller number of units, show them how getting more units can be even better. So, okay, last couple points here. There's always a reason to not sell. There's always a reason to not invest, but there are always tools, there are always reasons to invest as well if you do it right and you know what to look for and you have the right tools. So don't just sit on the sidelines. Figure out ways to stay involved and buy real estate and continue to build your portfolio. You're not going to regret it. The best time to buy real estate was 10 years ago, 5 years ago. The second best time is now. So you can't, as the real estate guys say, I take from them a lot, but that's because they've been so key in everything that I've learned as well. But you can't make money on real estate that you don't own, right? So buy real estate, make money on it, figure out the best way to strategize and get those assets and make it happen. So have a safe and happy new year. If you haven't listened to my podcast episode from last week, go back and listen to that, please, because it was a lot about how to set yourself up for success in the next year, what questions to ask yourself as you're reviewing this last year, how to ask those questions, what questions to ask so that you can strategize and set yourself up for a great 2023 and moving forward. So have a happy new year, stay safe, and we will catch you all in 2023.